So I'm basing this whole forecast on the fact that the Fed is going to be wrong. Economy's not as strong as they think it is. They're going to be cutting more than just the 50 basis points they're expecting. That combined with this ongoing central bank demand and what else is coming at us this year, Elijah, I think makes for a pretty strong year for the precious metals.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 6th through January 13th, 2025, while supplies last. This week we feature the 1-ounce Canadian Silver Falcon coin at just $2.75 over spot, the lowest price we've had on any sovereign coin in years. We also have the 1/10-ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today for the first time in 2025 is our good friend, Craig Hemke. Thank you so much for joining us today, Craig.
Always great to see you, Elijah. Is it still early enough we can say Happy New Year? I think it is.
I think so, definitely. Maybe at the end of January, that'd be a bit too late. But hey, it's not even halfway through January here. I did want to discuss your 2025 forecast that you have on your website, tfmetalsreport.com. One of the key things I wanted to note first is you go over the 2024 forecast, what went right, what went wrong. And can you kind of lay out for our viewers the purpose of this forecast and also kind of what you think happened in 2024?
Well, it does tie together. The 2 years do tie together. And you mentioned, why do I do it? I wonder why I do it too, Elijah. You start thinking about these things in December, and I start compiling charts that I think get an idea of the direction I think I'm going. Then for my adult ADHD to sit down and actually pour energy, 4 hours at a time, 5 hours at a time into writing the thing is exhausting. And for what, right? I mean, the things I get right, people are like, well, anybody could have seen that coming. And the stuff I get wrong, everybody's like, oh, what an idiot this guy is. He actually thought, and so that is why I do it, so that I can, because invariably I'm going to get stuff wrong, and I want to know why I got it wrong. I want to be able to go back and look and try to discern, what I was thinking at the time and why I got it wrong if I can. And so when I look back at last year, we entered last year, everybody was all hyped up. The markets were thinking 6 or 7 rate cuts. And the Fed was saying, no, maybe more like 3. So I figured there'd be this kind of a tough period before the Fed actually started cutting. I thought they'd do it by July. They did it in September. I thought that would be the driver. Looking back, though, now that wasn't the case. The driver seems to have been central bank demand as the main thing that underpinned the derivative price. These big positions get built up on COMEX for both the speculators and the banks, but we never had that big washout. We had these periods of consolidation, but we never really got shoved backward. And I think that central bank demand underpins the price, and it seems to be continuing. China stepped back up after allegedly taking 6 months off, with 5 metric tons in November, then 10 in December. So if this trend of central bank demand, physical demand, underpinning the price, buying all the dips, that should help promote a good year this year. So we're back to watching the Fed, see what they will do. I called the thing inversion reversion because I think the key indicator is the yield curve, which had been inverted for 2.5 years, but now it's reverted back to an upwardly positive sloping curve where the 10-year yield is higher than the 2-year. And that's historically when the recession actually begins. The inversion predicts a recession is coming. But if you look at the charts that the Fed puts out, the last 6 or 7 recessions have followed that inversion reversion. And that's what's now happened. The 10-year note's about 40 basis points higher than the 2-year note. So I'm basing this whole forecast on the fact that the Fed is going to be wrong. Economy's not as strong as they think it is. They're going to be cutting more than just the 50 basis points they're expecting. that combined with this ongoing central bank demand and what else is coming at us this year, Elijah, I think makes for a pretty strong year for the precious metals.
That should definitely be exciting. As you mentioned, central bank demand really is likely to continue in 2025. When it comes to, I guess, some of the major drivers, you mentioned the thing that really held up the gold price and made it rise 25% or so in 2024 was central bank demand. What are some of your price targets you might be looking for in 2025 with respect to gold?
It's, I was dead wrong last year about that. I thought, again, we'd probably go sideways for the first 6 months of the year. We went sideways only for the first 2 months of the year. I thought price would take off by July. Price took off in March. And then, so it got way ahead of itself. I thought we'd get to maybe 2,300, 2,350. And instead we got to 2,800 and finished the year, as you said, up 25%. So now you look back historically and you try to see, okay, what has happened in previous years after that big of a rally? Typically another rally follows, but not as much as that last one. So anything's on the table. The world is so crazy these days. And if the Fed, what if by the end of the year, Elijah, what if inflation is raging, but the economy is in the toilet, and by the December FOMC meeting, the Fed is talking about yield curve control and renewed QE to try to keep the long end down to finance the government? Who knows what the world's going to look like 10 or 11 months from now. And if that's the case, gold could be 3,500, 4,000. But I think knowing what we know, given the knowns at this point, at least as I think there are knowns, the next move should take us about 10% higher past the old all-time high. That's typically how it unfolds. You can see that price kind of unfolding that way as we move through 2024. So maybe that takes up to 3,100, 3,150 at some point later this year. And then, maybe continue to pull back and kind of wait and see from there. Maybe finish the year higher than that, maybe finish the year a little bit lower than that. But again, for precious metal stackers, that would be a pretty good year. We all get kind of caught up sometimes in the mining shares and what that does to sentiment of everybody because, GDX was up 8% last year. I thought they were supposed to outperform the metals. But for the metals themselves, they're doing just fine. And I would suspect they'll do just fine in 25 too.
When it comes to the U.S. recession, you mentioned how there's a great possibility of recession in 2025 because the yield curve is uninverting. And this is so interesting because I think it was Francis Hunt we had on, and he went over the yield curve inversion and showing really how every time it inverts and gets out of that inversion, we have some sort of crisis, recession. And it's just so predictable. It's kind of crazy. And this inversion is really, it's been longer and deeper than any one that we've seen in the recent past. One of the other things that has struck me over just about the last week, we had Francis Hunt, we had Michael Oliver, we had Christopher Mullen, all pointing to different factors that really signal within the next couple weeks, within the next couple months, we could clearly be seeing a downturn in the stock market, a downturn in the economy, really red alert signals showing that trouble is ahead. What do you make of? It seems like experts from all these different angles showing, and insiders also selling a lot of stock. Warren Buffett having his biggest cash position. Your take on all these kind of signals coming from different directions, showing that there could be trouble ahead.
Well, if anything, I try to do my part by, adding inventory for people to read. And I think that's how, people that are watching us right now should look at it. Michael Oliver does a great job. They should subscribe to his service and get his newsletter. I know Christopher Mullen. They're all, a lot of guys like me that share their opinion, and we all kind of have our niche area in a way. And so I would encourage, this is kind of the same caveat I tell people every year: find independent, objective sources of information, and then take it all in and digest it, and then think for yourself and discern from there where you think things are headed. We all kind of see it going into the same place, but from different angles, and so maybe that's helps people kind of see the light a little bit. A lot of the market concern is a liquidity issue, and And I wrote about this in last year's Macrocast. I wrote it again this year. There used to be $2.5 trillion parked at the Fed in their reverse repo fund, which is like excess reserves is what, the Fed pays interest on the excess reserves. Well, they didn't want that money further messing with the yield curve and everything else. And so the money was just kind of held there in 2023, and it actually got going in 2022. Well, Janet Yellen then decides that for the funding purposes of the federal government, she's going to issue a whole bunch of treasury bills and soak that money up. You get that money out of that reverse repo and get it out into the economy, get it into the bond market. And then from there, it's loose and it can go into stocks and provide liquidity for everything. Well, that reverse repo account now is down about 90%. Okay, so where's that added liquidity going to come from? And I think that's all that's a part of the piece of the puzzle for this year. Because again, at the end of the day, the Fed talks a good game. Powell likes to make himself seem like a man of the people, and we're worried about inflation, all this kind of stuff. But a choice will be made. His back, or whoever the head of the Fed will be, their back is going to be against the wall. And they're going to have to decide between, we're going to kind of toe the line with austerity, and not provide the funding for the government and all of the debt and the deficit and everything else. And it's just see what happens. We're going to try to get inflation down for the average guy. Or we're going to say, well, you know what? Everybody benefits from keeping this scheme going, from funding the $2 trillion a year in deficits, from making sure there's liquidity for the capital markets and everything else. So little guy be damned. We're, rising tide floats all boats. So we're just going to cut and QE and do all the stuff we've always done in the past, regardless of what the inflation level is. And so anyway, this may seem like kind of a rambling answer to your question, but I think other analysts are drawing conclusions from in their own niche area that they observe, but it's kind of in line with what I'm seeing too and other people are seeing. And these things all kind of line up to where I expect later this year. Now, I'm not the next Fed meeting's in 3 weeks. We may get jobs data on Friday that gets everybody all excited, maybe they'll start cutting again by, May or March or something. I don't know. But I'm talking down the line from here. What's it going to look like by summer or fall? What's the Fed going to be doing then? And I'll give you one last thing, Elijah. Do you remember, we've been doing this for so long. Maybe you do, maybe you don't. When I wrote my Macrocast for 2019, I called it 2010 plus 9. Well, the idea was that 2019 was going to look a lot like 2010. We began 2010. The Fed was saying, oh, yeah, Bernanke was saying that QE thing was a one-off. We just had to do that. I know we've never done it before, but we had to do that to save the world with the great financial crisis. We're never doing that again. The green shoots of the economy, wherever, all this stuff, right? And then by November of 2010, here came QE2. It was all, well, maybe we misspoke. Okay. So as 2019 began, it was a lot like this year. The stock market began to tank in 2018. Liquidity was drying up. It was going straight down. At the December FOMC meeting of 2018, the Fed was projecting rate hikes in 2019, and we got into a bind real quick. Well, they quickly shifted tune in the first half of the year, and we were cutting rates. By June, they were forecasting rate hikes, but the first rate cut came in June. So in a way, this could be 2010 plus 9 plus 6, because it's not exactly the same, but it's similar. And so, again, like last year, the market was convinced that there were going to be all these rate cuts, and they were wrong, and all that stuff had to sort itself through as we went through the year. Right now, the market's convinced, there maybe not be a rate cut now till September or June. Well, we'll see about that. It may not turn out exactly as everybody expects. It never does.
Now, with respect to precious metals, one of the things that some experts, it seems like, disagree on is, well, what's going to happen if we do see this recession and the stock market downturn? Will precious metals fall with it, or will people move into precious metals for safety instead? Your take on that this year?
That kind of depends on the speed and the severity of the down move in equities. If we get, August the 5th, of last year was a Monday, and the markets had been falling, and we got, I think it was mainly based off of Japan and the unwind of the Japanese carry trade. You probably remember that. People listening remember that. And by the time the markets opened on Monday, I think the S&P opened down like 1,000, S&P down 100 some odd points. And in the middle of the night, for us, during London hours, gold fell $100 in like 4 hours because it was one of the few markets that was trading at that time of the day. And if you needed liquidity, there you go. So if you get this really, we start talking, CNBC, crisis in the markets, that kind of stuff, where the Dow's down a couple thousand points a day for 2 or 3 days in a row. Well, then you're getting margin calls, and this liquidity concerns, and everything gets thrown out. If you're a hedge fund and you're levered up in equities, and you've also got a profitable position in 100 contracts of COMEX gold, you need cash. You're selling what you get, what has a bid, maybe what has a gain. You're going to raise that cash to meet your margin call. And that's when everything just plummets. If instead we get in more of a gradual decline, then it's more like people thinking on a regular basis. Well, maybe I should be rolling into gold here because this is showing the economy's going down and the Fed. So it really, anyway, long answer. I'm just back to where I started. It really depends how gold responds, silver too, in a general market pullback of 10 or 20% is going to be a function of how fast that pullback rolls out.
You also mentioned in your forecast U.S. deficits and debt and how really it's likely all of that is just going to continue. The U.S. debt is just going to continue to skyrocket higher. How do you see this impacting the economy and the gold market?
Well, this is a major part of that central bank bid and just general physical demand for gold. Elijah, this came out back in early December. People are already starting to kind of look for Christmas and shut things down. On the 8th or 9th business day of every month, the U.S. Treasury puts out their monthly Treasury statement. So this was back on like December the 9th, right? The U.S. fiscal year begins on October the 1st, ends on September the 30th. So the statement that came out on December the, whatever it was, 9th or 10th, was for the month of November and cumulatively the first 2 months of the year. The month of November alone was $366 billion of deficit spending. Yeah. That used to be a national, calamity when it was $366 billion for a year. And now it's a month. For the first 2 months of the fiscal year, $624 billion in deficit spending. So there seems to be, look, I want it fixed too, right? I wish it wasn't like this. But the problem is you can't wish it away and you can't just wish a fix. And this optimism that somehow this Doge committee with Musk and Ramaswamy, which has no congressional authority, let's say somehow vote to give it some, but I mean, there's no line item veto that the president has. So this optimism that somehow Musk and Vivek are going to trim, $500 billion off the deficit by, cutting out waste. Sounds great. But in reality, in practicality, are they really going to do it? Let's just say they're able to cut it by $200 billion or something. One, that's sadly a drop in the bucket. But two, if we get into this economic scenario that I think is coming, well, then economic activity slows, tax receipts fall, and the net difference might be nothing. You might cut spending by $300 billion, but then have your government revenue by tax receipts fall by $300 billion, and you're still running $2 trillion deficit. So you're talking about things that underpin the bid for gold. Okay, that problem is not going away. I mean, it's only, getting worse. What the line item for interest on the national debt last year was 1.1 trillion or something like that. So that, even though it doesn't always make headlines, those numbers are the ones that just remind people that, maybe I ought to divert, like these central banks. These central banks are taking their dollars and buying gold. Maybe I ought to do some of that myself. And that just, again, that keeps the dips being bought, keeps the banks unable to just, smash it backward, $500 to cover some of their shorts. And it keeps moving forward. And the uptrend we always seem to see in the COMEX, 2 steps forward, 1 step back, 2 steps forward, 1 step back. And I suspect that's how it's going to continue.
Now, with regard to investing in precious metals, obviously you can purchase the physical metal to hold on to. You can also play in the mining space. And you mentioned how in 2025, it might be good to be pretty selective as normal, but it's a kind of a different environment in the mining space right now. And you really have to pick and choose even more than usual because of, higher input costs and all of that. So can you expand on that?
Yeah, when I first started out of college, I signed up at Payne Weber and went through the Series 7 training and got my stock. I was a stockbroker. That's how old it is. I actually call myself a stockbroker right now. You're financial account executive or whatever they call it back then. But I was a stockbroker. And you were a stockbroker because you did the homework, right? You'd sit there, you'd pour through value line things, and look up Morningstar reports and in your own sell side research that came out of your firm, and you tried to find stocks that were going to do pretty well. And you convince your clients to buy them. That has all been, now it's all just, ETFs and managed money and wrap fees and passive investing. Well, that has carried over to the mining sector, right? People are, I want to put some money in the mining sector. I don't know anything about the mining sector, so I'm just going to buy the GDX. Well, the problem with that is, as I mentioned, the GDX was only up 8% last year versus gold being up 26%. Why? Because, and it's worse than just these two, but 20% of the GDX is Newmont and Barrick. Newmont was down last year. Down. Barrick was down 15% last year. Their share price. Gold's up 25% and Barrick goes down 15%. Why? Because they can't control their costs. So even as gold price is going up, their costs are going up just as fast. Their margins aren't increasing. And people. So if you're going, my point is, passive investing is now all the rage. Nobody wants to do their homework and be a stock picker and all that kind of stuff anymore, right? So they just passive invest to get the GDX. GDX underperforms and everybody says, to hell with it. This sector's terrible. Well, it's not really. Agnico Eagle was up 60% or something last year because they do control their costs. Kinross was almost up 100% last year because they do control their costs. So the point I tried to make in this year's Macrocast was not so much, hey, look at this chart at GDX and look at the 50-day moving average. And, if we can just get to this level, there should be some resistance. Phooey. If you're going to be in this sector, again, there are lots of, you and I know lots of folks that this is all they dedicate their lives to is looking at the mining sector. And they have a subscription website to tell you what, they know what grams per ton over a length of, drill hole and all that stuff. They know what that stuff means. If you're going to be in this sector, you're going to have to do some, you can't, even Stan Druckenmiller, Elijah, one of the greatest investors of all time. When headlines show up that Stan Druckenmiller's moving into gold, he buys the GDX and he buys Newmont. What? Come on, Stan. Newmont's the biggest dog in the doghouse. Like I said, it was down last year. So anyway, moral of the story in the mining sector. If you're going to do this, there's profits to be made. And if gold's going to 3,100, AEM's probably going to have another great year. You can do great. And you can get leverage to the gold price, but you're going to have to do some homework. You just can't simply just say, buy me the GDX and see what happens.
And if people are interested in learning more, getting more insights into the precious metals sector, they can go to tfmetalsreport.com. We'll also put a link to your yearly forecast for 2025 here in the description of this video. Any last thoughts before we let you go?
Well, let's see where we go. Keep an eye. One last thing I wanted to mention, and I just didn't seem to work it in. Another headline that was buried back in December was the People's Bank of China coming out and publicly pronouncing that they're going to have a moderately loose monetary policy this year. That the last time they had a moderately loose monetary policy they publicly announced was 2010. Okay, so we know what was happening in 2010 and 11. They then changed it to prudent. And they've publicly been saying prudent for 14 years since. but they said moderately loose. This is a pretty big deal too. We're seeing it already. Just the last 5 days, copper has turned a corner, blasted higher, broken its downtrend from September, moved above its 50-day moving average. This is another thing that's going to influence things too. Chinese markets, yield on the Chinese 10-year is collapsing. They may have bigger problems than that, and they may be trying to get ahead of it. But if that money, they're going to be cranking out, the printer. Here in the U.S., when the Fed turns on the printer, it all flows into stocks and Bitcoin and all this kind of stuff, right? Well, they don't do that so much in China. I mean, there's a lot of speculation in commodities. Remember the big blowout in spreads from the Shanghai Exchange versus the COMEX back in May that just forced the COMEX price higher. But anyway, understand that part about China is an important thing for this year too. We may already be seeing it in copper. Keep an eye on copper as we go through this month, and let's see if that isn't a precursor to a rally in silver. But anyway, other than that, please go to the website. Big, long article, as it always seems to be. You can also find it on my Twitter page at TF Metals. And then it's the pinned tweet in my profile. So you can find it there. It'll be up there. I leave it there all year long. So, it'll be there until I write the next one for next year, God willing. So anyway, thank you, Elijah. It's always fun to visit.
It's always great to have you, Craig. Thank you so much for your time, and God bless.
You too, my friend.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 6th through January 13th, 2025, while supplies last. This week we feature the 1-ounce Canadian Silver Falcon coin at just $2.75 over spot, the lowest price we've had on any sovereign coin in years. We also have the 1/10-ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.